Hey, welcome to edX World and another video in the AS A-Level accounting series. This video is going to be on the notional profit that is added by the manufacturing department to the finished goods when they transfer these goods to the sales department or to the warehouse, and also we will understand the provision that is required on the unrealized profit that is included in the stock. Do not forget to subscribe to the channel and press the bell icon. Many more videos will be uploaded in this series in future. Hope you do not miss them. In this video, we will begin with understanding the format of the manufacturing account that has already been seen in the IGCSE. Then we understand the markup or the profit that is added by the factory on the finished goods. Why do they add this profit and what all problems are faced when they add this profit? The effect of the factory profit on the net profit of the business. The entries that are required to account for the provision for unrealized profit on stock, and the presentation of the notional profit and the provision for unrealized profit in the financial statements. And finally, also we will see how to prepare the provision for unrealized profit on stock account. Obviously, when we understand the journal entries for provision for unrealized profit, making of the account shouldn't be a problem, but the account is specifically asked many times already in the past papers. So we will quickly go through and see how to make an account in the exam. So the format of a manufacturing account looks something like this. You've already studied this in the IGCSE. If you've not studied the format earlier, you do not understand the format, you are trying to remember the format without understanding it, I would suggest please go through the basics of the manufacturing account video. That the link will be provided in the description. The video is there in the IGCSE playlist. Once you watch that video, once you understand manufacturing account completely, this video will be much simpler. So what do you mean by markup on factory cost? See, when transferring the goods from factory to the warehouse or to the sales department, the factory will add a markup or a profit percentage over the cost of the goods they've produced. Why do they do this? So that they can match with the selling price of those goods in the market. If the sales department had to purchase these goods from the open market, what price would they pay? The factory would mark up their cost of the goods to that price. For example, Omni Manufacturers, a garment manufacturing firm, has a policy to add a notional profit of 30% over its production cost. The cost of production of the finished goods is arrived at 450,000. What will be the transfer to income statement value be? See, they will take their cost of production, the final cost of production of the finished goods, 450,000. To that, they will add 30% markup or 30% factory profit. So the 30% is calculated on the cost, which is 450,000. We get 135,000. This profit is added to the cost to arrive at the transfer price, and the sales department will get these goods at 585,000. If the sales department wanted to buy these goods from the open market, they would roughly get it at the same price. That is the logic behind adding the factory profit. So what does the factory gain by adding this profit over the cost? See, there are two important advantages. First, what is the motive or what is the advantage to the factory workers and to the factory supervisors of reducing their cost of production? Next question arises, what is the purpose of doing this? What is the advantage of adding notional profit over the factory cost? There are two important advantages or two important reasons why this is done. See, whenever factory workers or factory supervisors try to reduce the cost of production, they need some motivation. They need to be given due credit for their efforts. This can only be done when we can compare the cost of production to the open market price. If these goods are always transferred at cost to the sales department, there would be no motivation for the workers to achieve minimum cost of production. But when these goods are transferred at the open market price, the workers and the supervisors in the factory know that they are being noticed. The difference between the cost and the open market price will be visible, and hence there will be more motivation to reduce the cost of production in future. And second reason is the sales department, if they had to purchase these goods from the open market, they would do so at the transfer price. Or approximately at the transfer price. So it will only be fair for the manufacturing department and the sales department if the sales department is given credit only for the difference between the selling price that they achieve and the price at which the goods can be bought from the open market. If the business makes a good gross profit by achieving a high selling price and a very low cost of production, if the entire credit of this is given to the sales department, it will not be fair for the manufacturing department, and hence the markup of profit is added to the cost of production. Once this is done, what are the problems faced by the business? There are two important problems. See, when you notionally or artificially add profit to the cost of production, this transfer price is eventually recorded in the income statement and it artificially increases the cost of sales. When cost of sale increases, the gross profit and the net profit are understated. The business as a whole, this is not justified. This cannot be done. Within the business, it doesn't matter if there is a different transfer price from the actual cost of production. But when taken as a whole, the business cannot understate or overstate its net profit. Otherwise, the users of the financial statements will not get a clear picture of the performance of the business. Hence, the profit that was artificially added to the cost of sales will have to be adjusted later when calculating the net profit. The second problem is that the sales department or the warehouse will value the stock or the inventory at the cost at which they receive. Now, this cost, which is the cost to the sales department, includes artificial or notional profit. It means that the valuation of stock is also not accurate when considered for the business as a whole. So let's say the closing stock is valued at a price that includes the notional profit. This means we are overstating our closing stock, we are understating our cost of sales, and we are overstating our profits. But considering the business as a whole, this is not right. In the same way, if the opening stock is valued at a price that includes artificial profit, because of that, the cost of sales will be overstated and the profits will be understated. Hence, adjustments for these will also have to made towards the end to arrive at the correct net profit. So the first problem that I told you, that because of the notional profit that is artificially added to the transfer price to the sales department, because of that cost of sales is overstated and gross profit and net profit are understated, that can be corrected by adding back the factory profit that was added to the cost of production, by adding that back to the net profit towards the end of the income statement. Hence, when we prepare our income statement after deducting our expenses, the profit that was charged by the manufacturing department and added to the cost of production, that can be added back to the net profit at the end, and that problem can be solved. Apart from this, I told you there is also a problem in the stock valuation. The closing stock will be valued at the cost to the warehouse, which includes the notional profit. Now, effect of that, I've already told you that cost of sales is understated and profit is overstated. Because when closing stock is high, cost of sales is low and profit is high. And if this closing stock is taken at the same value in the balance sheet, the current assets in the balance sheet will also be overstated. This is not acceptable. It is in fact against the principle of prudence. Hence, to tackle this problem, a provision for unrealized profit is to be created. This is done by charging an expense to the income statement to the extent of the profit that is already there in the closing stock. See, understand, because of this profit included in the closing stock, net profit was artificially high. We can tackle with this by charging the same amount as an expense in the income statement, so that the profit that was overstated because of the high valuation of closing stock is now at its correct value. So this journal entry is used in the books of accounts to provide for that provision for unrealized profit. Income statement is debited because we want to charge this amount as an expense in the income statement, and the provision for unrealized profit account is credited. This provision for unrealized profit is nothing but it represents the artificial profit that is included in the closing stock. This closing stock would become the opening stock of next year, and in the opening stock again some notional profit is included. Because of this, what will be the effect on the income statement? The cost of sales will be overstated and profit will be understated. So how do we tackle this problem? We will have to add back an amount that is equal to the unrealized profit included in the opening inventory. We will have to add back that as an income in the income statement. Why? Because see, profit is understated because of incorrect opening inventory. When we add back that amount as an adjustment at the end, the net profit will then be showing at its correct value. We can do this by reversing the entry that we passed in the previous year for closing stock. When we arrive at the next year, we can just reverse that amount. When income statement is credited, it is nothing but adding a gain or a income in the income statement. So let's sum up the previous two presentations that we've seen, closing and opening stock. How is it actually done? If it's the first year of operation, there is no opening stock. So the only entry that will be passed in that year is the amount of profit that is included in the closing stock will have to be charged as an expense in the income statement, and hence income statement is debited here. In all future years of operations, there will be closing stock and opening stock. So for closing stock, every year we will need the same entry. Income statement will have to be debited and provision for unrealized profit will have to be credited. Again, why is this done? So that the profit that is overstated because of an incorrect closing inventory valuation, that is brought back to its correct value. Apart from this, we will also have to pass an entry for the adjustment of profit that is included in the opening inventory by reversing that at the beginning of the year. The amount that was used to record the unrealized profit on closing inventory in the previous year will have to be reversed in the current year by passing this second entry, which is provision for unrealized profit debit and income statement credit, to show that we are adding back that amount of profit in the opening inventory as an income in the income statement. So instead of passing these two entries, we can directly net out the entries at the end of the year. How? See, if the closing inventory is greater than the opening inventory, in other words, the profit on closing inventory is greater than the profit on opening inventory, for the difference of the profit that is included in closing and opening inventory, we can directly use the first entry, income statement, debit, provision for unrealized profit credit, and that difference in profit will directly be charged as an expense in the income statement. But if opening inventory is greater than closing inventory, or the profit included in opening inventory is greater than closing inventory, we can use the second entry to record the difference in that profit and directly record the net amount as an income and add it back to the profit. In the next presentation, we will see these adjustments wherein I'll actually show you how are these presented in the income statement. So this is the income statement. We've already seen in the previous slide that why factory profit was added to the finished goods. After that, if you realize here, the profit that is included in the closing stock will have to be deducted. Obviously, because of this profit, the net profit was actually overstated. So the profit element will have to be deducted here. And the profit element included in the opening stock is being added because when including this profit in the opening stock, net profit was being understated. So it is added. If you realize, the net effect of this is taken out. So if the closing stock is greater than opening stock, or the profit on closing stock is greater than the opening stock, the net amount would be negative. That's the same situation I showed you in the previous slide. Okay, the net amount will be, the difference between the profit will be shown as an expense. But if the profit on opening stock is greater than the profit on closing stock, the net will be a positive amount, will be added as an income. And that was the second situation I showed you in the previous slide, wherein I told you the difference in profit will be added. Then a total of the factory profit on entire finished goods and the stock adjustments will have to be taken out, added to the draft net profit calculated before this to arrive at the correct net profit for the year. In the financial statements, the presentation of inventory will differ slightly. Raw materials and work in progress, there is no change because there is no notional profit added in them. But finished goods includes the notional profit, especially if it is valued at the transfer price. That notional profit or factory profit that is included in the closing stock will have to be deducted before presenting the finished goods at cost in the balance sheet. If this is not done, the current assets would be overstated in the balance sheet. Okay. The two journal entries that I showed you, one for closing stock and one for opening stock, and then I showed you to record the net journal entry, the net effect of the journal entries if the closing stock is greater than opening stock and the opening stock is greater than closing stock. That concept will also be utilized here when preparing the provision for unrealized profit account. This account is very simple, only 3 entries to be recorded. This account begins with recording the opening balance on the credit side. And this opening balance is nothing but the profit that is included in the opening stock. And this account will also record the closing balance on the debit side. In the closing balance, it's nothing but the profit that is included in the closing stock as at the end of the year. The entry will be on 31st December, the closing entry, and the opening entry will be on the 1st Jan, assuming that the business is following a calendar year. Once you record the profit on the opening inventory as opening balance and profit on the closing inventory as closing balance, all you have to do is just balance the account. If the debit side is greater than the credit side, meaning the profit on closing inventory is greater than the profit on opening inventory, I told you earlier the difference has to be charged as an expense in the income statement. So on the credit side of provision for unrealized profit account, it will be recorded as an expense, income statement, and that's an expense or a loss for the year. But if the credit side is greater than the debit side, it means the profit on opening inventory is greater than the profit on closing inventory. I told you that the difference in that profit will have to be added as an income. So that difference will be shown on the debit side, again as income statement, but as a gain for the year or other income for the year. So I hope the preparation of this account is simple. Only 3 entries: opening balance, closing balance, and the difference will go as income statement. Okay, let's have a look at this example. Continuing our previous example, the manufacturer has policy of transferring the goods to the sales department by adding 30% markup or 30% profit, and certain information is given. Revenues for the business is given. The transfer of finished goods at transfer price is given at 585,000. If you remember, our cost was 450,000. Now, if given the transfer price and given the notional profit margin, can we arrive at the cost? Or if cost is given and notional profit margin is given, markup is given, can we arrive at the transfer price? Yes. I already showed you how to arrive at the transfer price if the cost is given. Now I'll also show you how to arrive at the cost if the transfer price is given. So let's say the transfer price is given as 585,000 and we know that the factory is transferring the goods at 30% markup. So what we'll do is, let's assume that the cost of production of the factory is 100. The profit that it is charging is 30%. So the net transfer price would be 130. In this case, the transfer price is given as 585,000. So using the mathematical calculation or mathematical equation, can we arrive at the cost? Yes, we can arrive at the cost as 585,000 divided by 130 into 100. If you calculate, you will get it as 450,000. So whenever transfer price is given, you can always use this calculation to arrive at the cost price. Opening and closing stock is also given at transfer price. Remember, we need to calculate the profit element that is included in the opening and closing stock. For that, we also need to calculate the cost of the opening and closing inventory. So let's do that first. So same formula, same logic I will use. So I'll say cost of opening inventory or opening stock will be 52,000 divided by 130 into 100, 40,000. So that tells me, or that shows me, that the profit element that is included in the opening stock is 12,000, 52,000 minus 40,000. And the cost of the closing stock that is shown above, 78,000 divided by 130 into 100. If you do the calculations, you will get it as 60,000. So that also shows you that the profit element included in the closing stock is 18,000, 78,000 minus 60,000. So this business wants to prepare an income statement. Income statement will be prepared starting with the revenues for the year, 750,000. Cost of sales will be calculated as usual. Opening stock, opening inventory, production of finished goods and closing inventory. All of these should always be at transfer price. Remember, if an exam inventory is not given at transfer price, it is given at cost, convert it into transfer price and then write it. When you do the calculations, gross profit is calculated at 191,000. Deduct the expenses that were given above. Let's go back to the question once. Other expenses given as 100,000. We will use that to calculate the draft profit as of the draft profit for the year, 91,000. Why am I calling it draft profit? Because some adjustments have to be made to arrive at the correct profit. I told you the factory profit that was added by the manufacturing department will have to be added back to arrive at the correct net profit. So we have it here, 135,000 will be added back. The profit element in the closing inventory will have to be deducted to arrive at the correct profit, so minus 18,000, and the profit element in the opening inventory will have to be added back, 12,000. The net effect of this is minus 6,000. If again, I will emphasize on this fact that the profit element included in the closing inventory is greater than the profit element included in the opening inventory. Hence, we have a negative adjustment. So difference in the profit will have to be adjusted as an expense in the income statement. The net effect of the factory profit and inventory adjustment is taken in the last column as 129,000. When we add this to the draft profit that we calculated, we get the net profit for the year as 220,000. Presentation in the balance sheet is simple. We are only doing the inventories part. Under that, raw materials and work in progress will not change. Whatever values have been given at cost, just record that. Finished goods will be recorded at transfer price. Obviously, transfer price would be given 78,000, but we need to deduct our unrealized profit that is included in that closing stock 18,000 to arrive at the cost of production, which is 60,000, and that should be shown in the balance sheet so that the current assets are not overstated. I hope this video was useful for you. If yes, please like the video. Please share the video with your friends. Do not forget to subscribe to the channel and press the bell icon. I'll see you soon with a new video.